The Fed has kicked off the rate cut cycle with a big bang 50 basis point cut, something that I had very specifically predicted back in August of 2024 itself. But what does this mean for equity markets? Is this going to reignite animal spirits in equity markets, something that had started to somewhat diminish since first week of August 2024? Or is it that we are headed into a recession and a nasty market crash that typically accompanies recessions? Or could we get a third scenario, which is that of a soft landing? Well, this is precisely what we are going to discuss in this video. Let's explore. Ladies and gentlemen, a very warm welcome to all of you. You might be noticing a change in my background, and that's because I am recording this video not from my office, but from the beautiful town of Glen Rock, New Jersey, which is about an hour's drive from New York City. I'm visiting the United States to spend some time with my sister and her family, and also to meet a few clients who are based in the United States. Ladies and gentlemen, I'm recording this video on the historic day of 18th of September 2024, the day when the FOMC, the Fed Open Market Committee, met and decided to kick off the rate cut cycle with an initial cut of 50 basis points. I call this day historic because exactly on this date, 17 years back, on 18th of September 2007, the Fed kicked off what was only the second rate cut cycle of this century with the very same 50 basis points cut. That in turn kicked off a chain of events which led ultimately to the start of a brutal 60% crash in the Nifty between January and October of 2008. And that's why, ladies and gentlemen, I hope and pray that the similarities between that cycle and the current business cycle is limited only to the start date of the rate cut cycle and the quantum of the first rate cut. But today's 50 basis point cut by the Fed should not come as a surprise to anyone who has been following me on my channel, because this is something that I had specifically predicted as recently as August of 2024 in this recent video of mine which I had published on 7th of August 2024. If you haven't seen this video, at least go through this short 1-minute clip from this video that I'm going to play out for you right now. Well, the Fed starting to cut rates in September is no longer in debate. That's a given now. What's in debate right now is the quantum of rate cuts that's going to come in September. Is it going to be the regular 25 basis points that the Fed typically cuts in each meeting during a rate cut cycle? Or is it going to be a larger than expected 50 basis point cut? So is it going to be a 25 basis point cut or a 50 basis point cut? Well, if you ask me, I think it was a mistake on the part of the Fed to not start rate cuts in July itself, given how bad the demand condition already is in the US economy. But since they did not start rate cuts in July, the damage to the economy because of high interest rates is going to be that much more. And by the time they meet the next time in the middle of September, I believe by that time the economy will be in such a bad state that they might not have any other choice but to go straight for a 50 basis point cut. So, ladies and gentlemen, there you have. Just as I had predicted, delaying the start of rate cuts all the way up to September has only meant that the Fed has had to kickstart the rate cut cycle with a larger than expected 50 basis point cut. Is nothing but an admission of the fact that the Fed is now behind the curve with respect to cutting rates. In fact, this is the very same reaction that equity markets here in the US gave in response to the rate cuts by the Fed. Despite a 50 basis point cut, equity markets here in the US closed in the negative today, which was the equity market's way of conveying to the Fed that the Fed continues to remain behind the curve with respect to cutting rates. But now that the Fed has started to cut Fed funds rate, many of you have been prodding me to provide an update on how I see market conditions evolve from here. And while I will endeavor to offer a market outlook update in this particular video, ladies and gentlemen, to be honest, I do not have anything substantially new to offer to you in this particular video, because my market outlook does not necessarily change or evolve very frequently based on new events and developments in financial markets. Now, those of you who have been following me on my YouTube channel for a while would know that my market outlook that I have been reiterating at least since May of 2024, which is when I published this video, and then followed it up with this video a couple of weeks later in June of 2024, is that I expect the equity market rally to accelerate in the aftermath of the general election results in India once it is confirmed that Mr. Modi is going to assume office for the third time. But back then itself, I had also reiterated that I do not expect the post-election rally to sustain for too long, especially if bad news related to a worsening US economy starts to become more and more pronounced. And that is ultimately going to force the Fed to start rate cuts. And as you just heard, my prediction back then was that the Fed will be forced to start rate cuts by no later than September of 2024. And today, when we look back at events over the last couple of months, I hope, ladies and gentlemen, you would agree with me that things have played out pretty much in line with this very script. First, we did see a significant acceleration in the equity market rally once it became clear that Mr. Modi is going to come back to power for the third time, even though Mr. Modi came back to power with a significantly weaker mandate. Also turned out to be true is that this post-election rally very quickly started to fizzle out by first week of August 2024, once it became clear that the US economy was showing very, very clear signs of weakness, especially the US jobs market was starting to show very, very clear signs of weakness. The first week of August 2024, the Bureau of Labor Statistics of the United States, the BLS, released the jobs report for the month of July 2024, which clearly showed that the rate of new job creation in the US economy was starting to slow down very, very significantly. Even more alarmingly, this report showed that the unemployment rate in the US had now inched up to a level of 4.3%. This led to fears that the US economy is on the brink of slipping into a recession, and as a result, equity markets in US and indeed around the world pulled back very, very sharply in the first week of August. This is around the time when I came out with my last market outlook video, in which I clearly indicated that I do not expect the correction to sustain for too long. In fact, I clearly also indicated that I see the correction as a very, very good opportunity for investors to, in fact, increase their equity allocation in their investment portfolios. In this market outlook video, I had once again reiterated my view that I expect the Fed to start cutting rates by no later than September of 2024, and that I expect the equity market rally to once again resume and, in fact, accelerate once the Fed starts to cut rates from September 2024 onwards. And well, the Fed chairman did not disappoint. In fact, he did validate my prediction by starting to cut rates today from 18th of September 2024. Not just that, he's kicked off the rate cut cycle with exactly the quantum of rate cut that I had predicted, 50 basis points. But now that the Fed has started to cut rates, what remains to be seen is what I had predicted for the markets for the post-rate cut period also turns out to be true or not. But what is it that I had predicted for the markets for the post-rate cut period? And those of you who have followed me on my YouTube channel would know that my expectations about how equity markets are likely to evolve in the post-rate cut period is largely shaped by what I have seen happen to equity markets in the post-rate cut period in previous business cycles. And the common theme that has played across most business cycles in the post-rate cut period is animal spirits sort of get rekindled once the Fed starts to cut rates, because equity markets invariably interpret the start of rate cuts to be a very, very bullish signal, because equity markets tend to believe that cost of capital would start to come down once the Fed starts to cut rates, AMIs would start to come down on business loans and consumer loans, and that in turn is likely to be very, very stimulative for stocks. This in turn typically leads to very strong rallies in equity markets in the immediate aftermath of the start of rate cuts. But as I've stressed in many of my previous videos, that's a completely erroneous conclusion, because the real reason why the Fed has to typically start cutting rates towards the end of every business cycle is not really because the Fed wants to pander to equity markets, but the Fed has to start cutting rates towards the end of every business cycle is because by then the aggregate demand condition in the US economy is in such a bad state, and the unemployment situation in the US economy is in such a bad state, that the Fed literally has no other option left but to resort to rate cuts, in the hope that rate cuts would probably be able to prevent the US economy from slipping into a recession. But guess what? The Fed has never really been successful in its plans. And despite the Fed starting to cut rates, the US economy has invariably slipped into a recession historically, and that too typically within a span of 4 to 5 months from the start of rate cuts. Now let's take a closer look at how this theme has played out in the last two business cycles. And this could be a bit of a repetition for those who have seen my previous videos on rate cut, but it may not be a bad time to do a quick recap even for those who have seen my previous videos on rate cut. So this is how the Fed funds rate has moved over the last 20 years. And this blue line represents how the Nifty has moved over the last 20 years. And as I mentioned earlier in this video, Fed started to cut Fed funds rate from 18 September 2007 onwards. And as soon as the Fed started to cut rates, that in turn triggered the final and the most violent part of the melt-up, which was already underway. And this melt-up continued for 4 more months, all the way till January of 2008, which is when the Nifty finally peaked. But in this short 4 month period between September 2007 and January 2008, Nifty rallied a staggering 45% rally in just 4 months' time. But finally, this rally started to fizzle out by January of 2008, which is when the US economy finally slipped into a recession. And as soon as the US economy slipped into a recession from January 2008 onwards, the Nifty also witnessed a brutal 60% correction between January and October of 2008. Till date, this 60% correction continues to be the worst correction in the history of the Nifty. Something very similar happened in the next business cycle. In the next business cycle, the Fed started to cut Fed funds rate from August 2019 onwards. And as soon as the Fed started to cut Fed funds rate, that triggered a rally in the Nifty that went on till January of 2020. And in this intervening period of 5 months between August 2019 and January of 2020, the Nifty rallied by 13%. I know the scale of the rally this time around was significantly lesser than the scale of the rally that was witnessed in the run-up to the global financial crisis of 2008. But the reason for that is that this rally was sort of cut short because of the abrupt onset of the COVID pandemic in early 2020. I personally believe that had it not been for the abrupt onset of the COVID pandemic, this rally would have gone on for longer, and probably the scale of this rally also would have gone on to become something comparable to the scale of the rally that was witnessed in the run-up to the 2008 crisis. But the final fate of this rally was exactly the same as the pre-crash rally of 2007. This rally abruptly came to an end finally in January of 2020, which is when the US economy finally slipped into a recession because of the onset of the COVID pandemic. And as soon as the US economy slipped into a recession, we got a massive 38% correction in the Nifty. But does it necessarily have to happen this way? Do we necessarily have to get the start of rate cuts first and a stock market correction can start only after the start of rate cuts? Well, absolutely not. And in fact, we do have precedents of the stock market starting to crash even before the start of rate cuts. In case of the business cycle that was on around the turn of the century, the Fed started to cut Fed funds rate around January of 2001. And as soon as the Fed started to cut Fed funds rate, that was followed by the onset of a recession in the US within a matter of weeks. However, in case of this particular business cycle, as you can see, the Nifty, which is represented by the blue line, had peaked long before the start of rate cuts. The rate cuts started only around January of 2001. However, the Nifty had peaked already by around February of 2000 itself. So how is it likely to go this time round? Is it likely to be a repeat of what happened in 2001, or are we likely to see a repeat of what happened during the global financial crisis of 2008 and the COVID crisis of 2020? Well, it could go either ways, and we have to be open to both the possibilities. Having said that, I'm not just a content creator, I'm not even a theoretical economist who has the luxury to just enumerate the various possibilities that can play out. I manage money for a living, and anybody who manages money for a living has to make explicit black and white choices from the various possibilities. After weighing the odds of both the scenarios, my view right now is that, and it has been the same view for a very, very long time, the highest probability outcome from here is likely to be a repeat of what we saw in the run-up to 2008 and in the run-up to 2020. And I say so because I believe that the recession of 2001 and the market crash that preceded it, which is also referred to as the dot-com bubble burst, were an outcome of a very peculiar set of market conditions which are very, very unlikely to repeat. Usually, a market crash is the outcome of a recession in the real economy. It starts off with a slowdown in the economy. Eventually, we get a recession in the economy. That in turn leads to a very severe slowdown in demand of goods and services of various companies listed on the stock market. And that in turn leads to the stock prices of these companies tanking, and ultimately we get a large stock market crash. But the dot-com bubble burst, which was the equity market crash that started in February of 2000, was a market crash of a very, very different nature. This crash was an outcome not of a slowdown or recession in the real economy. Instead, this crash was an outcome of an absolute frenzy in the stock market, and that too in a very specific segment in the stock market. There was an absolute frenzy amongst investors investing in tech stocks of the time. There were multiple instances where companies would just add .com at the name of their companies and the share price of the company would shoot up many, many times. So it was clearly a bubble by any standards. And boy, what a crash it was. The Nasdaq went down by as much as 86%. What is even more unimaginable by today's standards is a stock like Amazon lost 93% of its value during the course of the dot-com bubble bust. But while it was a very painful experience for investors investing in tech stocks, the wider economy in general was doing just fine. In fact, even during the course of the recession that started almost 1 year later in January 2001, we only got a very, very shallow recession. The scale of GDP contraction during the course of the 2001 recession was only 1.3%. Compared to that, the scale of GDP contraction during the course of the 2008 recession was 3 times as much, 4.3%. The peak unemployment rate that was hit during the course of the 2001 recession was just about 6%. During the course of the 2008 recession, the peak unemployment rate went up to as high as 10%. But compared to 2001, we have a very, very different set of conditions prevailing today. The economy is showing very, very clear signs of a slowdown. What is even more alarming is that the unemployment rate is already up at 4.2%. And that is why this economy and this market looks to me to be far more similar to what was witnessed in the run-up to 2008 and 2020 rather than what was witnessed in 2001. There's also a third scenario that is possible, and this scenario is called soft landing. In the soft landing scenario, the Fed basically is able to very carefully calibrate the rate cuts in such a way that we only get a slowdown in the economy and the Fed is able to prevent the economy from slipping into a recession outright. The impact on the stock market in the soft landing scenario has historically been far less adverse than what is usually the case in case of a recession. But here again, my view is that the odds of a soft landing are very, very slim. Because in the last half a century or so, the Fed has been able to engineer a soft landing only once, and that is in 1995. Now coming to the most important question. If the highest probability outcome is likely to be similar to what was witnessed in the run-up to the recessions of 2008 and 2020, then how is it that we should position our investment portfolios at this stage? Now, this is a question that I have already answered in this previous video of mine, which I had published on 6th of April 2024. In this video, I had basically laid down a set of 3 conditions which must be fully fulfilled before a material market correction can materialize. And what were these 3 conditions? These were the 3 conditions. The first condition was that the balance in the reverse repo facility should go down to 0. Second condition was that the Fed should have started cutting Fed funds rate. Finally, the third condition was that the yield curve should have uninverted. So far, only one of these 3 conditions has been fulfilled. The Fed has started to cut Fed funds. The remaining 2 conditions have not yet been fulfilled. Many of you have pointed out to me that the condition related to uninversion of the yield curve has also been fulfilled. But my dear friends, that's not true. The condition related to yield curve uninversion has not yet been fulfilled. If you go through my previous videos on yield curve inversion, you would notice that the yield curve that I focus on is the 10-year 3-month curve. What has recently uninverted is the 10-year 2-year curve. That's not the one that I focus on. The one that I focus on is the 10-year 3-month curve, and that continues to remain very, very significantly inverted. In fact, I believe that given the current set of market conditions, there is very little chance that the 10-year 3-month curve can uninvert before the Fed meets the next time round, and the next Fed meet is scheduled only in November. Which basically means that there is very little chance in my view of the 10-year 3-month curve uninverting before November of this year. This is something that I will elaborate more in my next video. In my next video, I'll explain where do we stand with respect to the yield curve and why is it that I believe that the 10-year 3-month curve is very, very unlikely to uninvert before the next time the Fed meets in November. Now, coming back to the set of 3 rules, given that only one of the 3 conditions has so far been fulfilled, I believe that the conditions required for a sizable market correction to materialize is not in place yet, and hence I continue to remain fully invested in equities in my personal investment portfolio. But at what stage should we start exiting our equity portfolio? Well, for that, we need to first wait for all these three conditions to be fully satisfied. Right now, we have only one out of these three conditions that has been met. So we need to wait for all these three conditions to be fully satisfied. And it's not as if that I'm suggesting that you should immediately exit your entire equity portfolio the moment all these three conditions have been fully satisfied. Instead, we need a calibrated strategy to gradually plan our exit from our equity portfolio after all these three conditions have been fully satisfied. And this exit strategy is, of course, very, very critical if you are planning to participate in this last leg of the rally that is likely to play out between now and the onset of a recession in the US. But what is the exact contour of this exit strategy? Well, that is something that I'm going to discuss over the next couple of weeks and months as we come closer to the point where all these three conditions have been fully met. Also, over the next couple of weeks and months, I'll try to discuss a few more global macro parameters that we use as part of our proprietary alpha SIP logic, because these global macro parameters have historically been very, very useful in predicting the onset of a market crash before the actual onset of a crash. Either ways, ladies and gentlemen, one thing that I can assure you is that an absolute roller coaster of a ride awaits us over the next couple of weeks and months as we head into recession season in the US. And this is a ride that will present risks and opportunities to equity market investors in equal measure. I'm not trying to suggest that I have any kind of a crystal ball which is going to help me pinpoint the exact point where the markets are going to make a top and the exact point where the markets are going to make a bottom. What I do know based on historical experience is that as long as we are following a rigorous, time-tested analytical approach, and based on that we are able to get the point of exit before the crash and the point of re-entry after the crash has played out even partially right, then there is very, very serious money to be made over the next couple of weeks and months. I'll try my level best to offer my guidance to all of you as we navigate through this choppy ride that awaits all of us. This brings me to the end of this video, but before I conclude, I want to introduce somebody really special. And that is my 11-year-old nephew, Rishan Gupta, who is trying to learn elementary finance and compound interest from me while I am here. Over to you, Rishan.
I hope you liked the insights that my uncle shared with you throughout this video. If you did, please make sure to like and share this video. Also, please do consider subscribing to this channel.